Okay, so when we are talking about the economy and all the different aspects that have happened, there's been a lot happen in October and September that have really translated into what's going to be happening this November. Now, basically, there's a huge aspect that we are needing to talk about. Obviously, that comes down to the elections, and whether you are watching this video prior to the elections or after the elections, they have had a big impact on where the investments, where the stock market, where the economy are going. You see, whether we have a Democrat in power or whether we have a Republican in power, they provide different thought processes, and those thought processes can dictate some ideas. But here's the big aspect. A lot of what we have already been talking about with respect to the economy does not come back to the election. It does not come back to the outcome of the election. It comes back to what is already in place with respect to the economy and where we're headed with inflation. So let's talk about that and dive into those details. The first aspect that I want to be discussing is that things have actually become a little worse since the beginning of the year. So we know more and more that we are going into a recession. Now that is something that we look at what's called the yield curve, and this is a very negative number. That means that short-term bonds are going up faster than long-term bonds and the interest that they're paying out to you. Now that has a track record of signaling a recession. But let's put that aside. Let's take a look at other companies that are out there. You see, over the last couple of weeks, we've heard reports from a lot of the major technology companies as well. And those reports are not good. Those reports are actually saying that things are getting worse, not better. And while that may not translate necessarily into the stock market, we have to be aware of what is out there. So when we hear the fact that we have mass layoffs at a lot of these technology companies, we have to take note. Now, one of the primary ones that I want to be addressing is Amazon. You see, when Amazon, over the last number of recessions, when they would be looking at how much of staff do they need, what they should be doing in the recessions, they've always looked at it in light of the fact that they should be adding more capital, really trying to expand more during a recession. And they have taken advantage of that. Well, this time around, they're saying the exact opposite. They're saying we need to be laying off people. We see a more prolonged recession. We need to be laying off people and we need to be cutting back on some of our expenditures. That is a huge driver for other areas. And what I mean by this is the fact that Amazon is quietly becoming one of the largest employers in the nation. And if they're starting to lay off people, well, now we can start seeing trends starting to happen, whether it is with other technology companies, other industrial companies, other manufacturing companies, and yes, other small businesses that are out there as well. So the trend, even though right now we still have a lot of opportunities out there for employment, and the statistic right now is we have more job openings than there are people to fill those jobs. Well, that is obviously an incredibly good thing to have when you're trying to find a new job, but that is also what we call a lagging indicator. That's not necessarily indicative of what's to come. And so we see those things that are coming. We see the fact that we have a recession coming. We see the fact that there are layoffs that are happening versus hiring that's happening. All of that is to come back and say that the Federal Reserve is another element that we need to be looking at. And right now, the Federal Reserve says, even though we have these recessions, even though we are seeing companies that are starting to lay off, we still see those job openings. But more importantly, we still see inflation as sticky high. And because of that, our Federal Reserve Chairman, Jay Powell, is saying he really wants to be fighting inflation at all costs. Now, this is nothing new. We've been talking about this all year. But what's different is that basically the stock market and all the companies that are there are wanting the Federal Reserve to stop raising interest rates or to slow the pace. And while that may come, they're looking at this as the opportunity saying to buy into stocks, buy into investments that are going to go up in value. Now, that may or may not happen. That all comes back down to which stocks and which investments you're going into, if they go up in value or down in value. But no, when we are raising interest rates, which we're doing, that starts to curb how much money we can spend. So as a consumer, yes, that's going to be actually pretty detrimental because we cannot be financing more of our spending. So whether that means taking out loans via a home equity loan or using our credit cards that are having higher interest rates today than they did, say, last year, all of that's a negative. So that curbs our spending. But then let's take a look at the seasonality. Let's take a look at where we're at for Christmas and saying we need to be buying gifts. So the thought process now, because what we're starting to see is that people are starting to put more and more money onto their credit cards and less into savings, is that we do think that we're going to get through this holiday period and we're going to get through with retailers having some good numbers because we are still going to spend money. But after that, after the Christmas season is over and all the shopping that we've done, there's going to be a reckoning. And that is translating into possibly a very, very poor start to 2023. So just know that those interest rates do matter, and it matters to how you and I are spending money. Now, also what's coming is the fact that we see what we call comparables getting harder. So from 2020 to 2021, we had an incredible boost of spending that we did as consumers. Companies started to see some record high profits. Well, that's changing. Now they have to compare against those numbers, and things are looking a lot worse. So while they may still have had some good numbers, they may have had a good quarter, it's not as good as what it used to be. And when we start looking at where our economy is going and the fact that we are hiking those interest rates in the face of a very kind of soft economy, could tip us more into a recession sooner. So when we take a look at inflation and the economy, both of those are still not in a good place. And when we see those types of elements starting to happen, we know very clearly there's going to be some places we do not want to be invested into. But yes, there may be some other places. But here's the aspect that I want you to know. That no matter what, when we're in this environment, and right now, this is what I call a lead 4 environment. The Lions Wealth Economic Activity and Development Stage 4. And what that is saying we do have inflation that is starting to slow in the pace of the growth. So a slowing of inflation. And we also have a slowing of our economy. And that alone is a reason to be a little more cautious about where you're invested. So it may not be that we want to be heavy into certain types of investments. We want to maybe say keep a little more of your money, your assets, your investments in a less risky type of an investment. Now, there's plenty out there that you can be looking into. And as you have questions, as you want to go through a second opinion on your wealth and where to be invested today, please feel free to reach out, as we would be happy to talk about and go through a one-on-one consultation with you. But like I talked about, with those investments, as we want to be a little more less risky, I guess that's a really poor way of saying it, but you get the concept here, that we want to be a little more on the aspect of, say, let's keep our powder dry, let's get through this environment, and this lead 4 environment, mathematically, we are seeing will be in for probably another 9 months. So that gives you the opportunity to say, let's make some changes, as changes are warranted, to get through this environment, so that we can be coming out better on the tail end. Now, that again is just an outlook for where we're at today, but just know that between now and year end, we may still see a lot of spending from the consumer. But what we're also starting to see are that housing prices are starting to come down, rent prices are starting to moderate, cars and autos the prices are starting to subside just a little bit, and inventory is starting to build, not only in the auto section, but in other areas. And all of that is saying that we have a weakening of demand. When we have a weakening of demand, that means the economy is slowing down. Couple that with inflation that the Federal Reserve is trying to figure out a little bit more, makes for a very precarious time. Now again, take this to heart. Look at your own wealth plan and your investments. See if there's any changes that are needed. Maybe there aren't, but just taking a look at that is going to be beneficial so that you know that you are in a good place and that you can help yourself become in a better place for the future. With that, again, reach out as you have questions. I'd love to talk to you and go through a one-on-one second opinion consultation, which is complimentary, just for watching this video. Have a great day.